The next section is called the dual nature of transactions, which is really a fancy way of saying how does the transaction look from the buyer standpoint and how does it look from the seller standpoint. So we're going to take one transaction recorded on the buyer's books and also on the seller's books. Now I've given you a table right there with some journal entries on it. Did you see that? You might want to keep that handy unless you've committed all those to memory.
Perhaps I can.
Now we're going to make a series of journal entries. And we're going to make an assumption in all of these, and that is that any time the buyer buys merchandise, they plan to resell it. They plan to resell it, okay? So when they buy it, they're always planning to resell it. And in our first entry, Darth Vader buys from Yoda on account 10 lightsabers, $400 each, terms 210 net 30, FOB shipping point. The lightsabers originally cost Yoda $250 each. Well, the first thing we need to see is the total amount that we are paying if we are the buyer. Now we bought 10 lightsabers. How much are we paying per lightsaber? $400. So 10 times 400 says my total cost to begin with is going to be $4,000. But is there anything else that's going to impact the amount at which I record my purchase? 210 net 30. That says if we pay them by day 10, we can take a 2% discount. And remember, we will make the assumption when we record this purchase that we're always going to take the discount. So 2% of 4,000 says we would be able to save $80. So it's not going to be a $4,000 purchase. Instead, we'll reduce it by the 80, and this would now be a purchase of $39.20. What do we have more of? We have more inventory. Inventory is an asset, and assets go up with a debit because we're making the assumption that we're buying all this to resell. What else do we have more of? Accounts payable. Good. Now, there's two ways you knew that. Number one is the phrase on account. But you know what? I could have given you this problem and not had the phrase on account there. You still would have known that it was a credit transaction. Why is that? Because I gave you terms. Anytime you see terms, it is a credit transaction. Now, let me mention that the format of the way I've given this to you on the handout is a little bit different right here. Before, when we've made a journal entry, I've given you the full journal entry box. In this case, this is just the way I'm going to give it to you on the test, actually. Do you see where I've got the buyer on the left side and the seller on the right side? That's because there's a lot of relationships between what happens on the buyer's books and what happens on the seller's books, and I want you to have them side by side because I think that will help you. Now, it's going to unfortunately require that you write small and write neat to get here in these boxes what we need to. All right, so instead of writing out the whole journal entry in the normal journal entry box, we're just going to write it in this smaller area here. We're the seller now. We are Yoda selling 10 lightsabers, $400 each, terms 210 net 30. At what amount am I going to record the sale? At what amount did Darth Vader record the purchase? $39.20. At what amount will Yoda record the sale? $39.20. Exactly. All right. So remember, the seller makes two journal entries. The first journal entry is for $39.20. What do I have more of? I have more sales. I heard that. That's good. Sales is revenue, and revenue goes up with a credit. So do me a favor. Don't write down the first line. You can go in and jot down your credit to sales is fine on the second line. The other thing I have more of is accounts receivable. Good. Customer owes me more money. More accounts receivable, that's an asset, and assets go up with a debit. So I have more accounts receivable, the asset goes up with a debit. I have more sales, revenue, and it goes up with a credit. The second entry we're going to make is to update the inventory. Because when I make a sale, what happens to my inventory? It goes down. It's for how much the items cost me. The first entry is what I sold it for. The second is what it cost me. Now, I sold, how many lightsabers? 10 of them? And each one of them cost me how much originally? $250. So 10 times 250 says I'm going to record the cost of what I sold as $2,500. What do I have less of? $2,500 less of now. I have less inventory. Inventory is an asset, and assets go down then with a credit. So skip the debit if you would. Just record a credit to merchandise inventory. Now, when I bought the inventory, it was an asset to me. It becomes an expense to me when I do what? When I sell it. And the name we give to that expense, when I sell my merchandise, what the merchandise called me is called what? Cost of merchandise sold. Good. COMS, cost of merchandise sold, or cost of goods sold. Very good. The most important part about that is that cost of goods sold is an expense. So when we debit it, we make it go up. Just like when we used up supplies, they become supplies expense to me. When I sell merchandise inventory, it becomes cost of merchandise sold to me. I want you to notice that if the buyer has more inventory, the seller must have less inventory. Now, do you see they are for two different amounts? Because each one records inventory at the cost to them of that item. And if the buyer has more accounts payable, the seller always has more accounts receivable. Darth Vader returns 2 lightsabers to Yoda. He has not paid for them yet. We won't give him a cash refund. We're going to reduce what he owes me. How many did we return? 2. And how much did we pay for each one when we bought it originally? 400. So 2 times 400 says we're going to start off looking at an $800 return for starters. However, what else do we need to take into consideration? The discount. We didn't record the original purchase at the full price, did we? We bumped down the discount. So the return also must be recorded at the reduced price. So a 2% discount knocks $16 off of that, and instead we're going to record the transaction for $784. So it is a $784 return then to us. What do I have less of? I have less inventory. Inventory is an asset, and assets go down with a credit. So we're going to credit merchandise inventory. If you'd like to do that first, that's fine. Credit merchandise inventory. Just put that on the second line. Leave a little gap for the debit on the first line. What else do I have less of? Accounts payable. I don't owe as much anymore. That's a liability, and liabilities go down then with a debit. So we will debit accounts payable, and we will credit merchandise inventory for $784. On the seller's books, returns get a little bit more complicated. You might recall we talked about with sales returns, there really are 2 parts of this. The first part is the adjusting entry we must make at the end of each accounting period. Let's kind of review that. Now, I don't have a place for this on your handout. You may want to write it down at the bottom of the page or over to the side, because I think for this entry here to make sense, we need to understand what's already on our books from the adjusting entry then. These are the adjusting entries that we're going to make. The first entry is a debit to sales, which makes sales go down, and a credit to customer refunds payable. The amount of that entry is the amount of refunds we expect to issue. So, for example, if my sales for the year were $10,000 and I thought we'd have a 5% return rate, 10,000 times 5% says I would record that entry then for $500. Why do we debit sales? Well, we know customers are going to bring stuff back to us. We don't know for sure who or what, but we know they're going to bring stuff back. Debiting sales will make it go down. It will cancel out the original sales we recorded. The credit goes to customer refunds payable. Payable is a liability. Okay, we know we're going to owe somebody for these refunds. We know it. We don't know who. We don't know exactly how much per person, but we know we're going to owe somebody. So that's why we credit customer refunds payable. The second entry is for the cost of what they're going to return. My debit goes to estimated returns inventory. Just think about it. We know people are going to bring stuff back, but have they brought it back yet? No, it's going to happen in the future. So we can't debit merchandise inventory. We're going to debit an account that's similar to merchandise inventory, but when you don't know what it's going to be, we're going to debit estimated returns inventory. And then finally, we're going to credit cost of merchandise sold. Now, cost of merchandise sold is an expense. When we credit an expense, we make it go down. Why is that? Well, when we sold these items originally, we debited cost of merchandise sold. Now we're having to cancel it out. So those are my 2 adjusting entries I make. Which of those accounts will be closed out when we go to make closing entries? Will we close out sales? What type of an account is sales? Revenue. Do we close out revenues? Yeah. So if you've written that down, you might want to even come back and strike through sales, because this could be closed out. Will we close out customer refunds payable? No, that's a liability. Don't close it out. How about estimated returns inventory? Will we close that out? No, that's an asset. How about cost of merchandise sold? Will we close that out? Yes, it's an expense. We're going to close it out with the expenses. So you might want to line through that also, because what I want you to understand is that all of these adjusting entries, what's still on our books going into the next accounting period is customer refunds payable and estimated returns inventory. So Back to our question, okay, which will still have a balance that carries forward, again, the payable and the inventory. Now on the seller's books, when the customer brings something back to me, they haven't paid us yet, they still owe us. What do I have less of? What's the most obvious thing I have less of? Accounts receivable, good. That's an asset, and assets go down with a credit. So if you'd skip a line, if you would just skip a line and put in your credit to accounts receivable. Now look back at the adjusting entry that we talked about. Customer refunds payable is the liability for the amount of refunds I expect to have to pay. When I actually end up paying those refunds, what do you think needs to happen to that liability? It needs to go down. Because if I estimated that I was going to owe $10,000 in refunds, for example, when I actually pay $1,000 in refund, what happens to that liability? It goes down, because now I'd only still owe, what, $9,000 in refunds, right? So my debit goes to customer refunds payable to make that liability go down. And you just told me my credit goes to accounts receivable. Now the amount of that entry is the amount I actually have to refund. The second entry is to update the inventory. The amount of this entry is for how much those items originally cost me. They returned 2 items. How much did I pay for them originally when I bought them? $250. So this second entry is going to be for $500, what the inventory cost me. Easy part first. What do I have more of when the customer brings this stuff back to me? I have more inventory, more merchandise inventory. That's an asset. Assets go up with the debit. The credit is what I think is the oddest part of what we do here. And my credit goes to estimated returns inventory. So what have we done? We took it out of one inventory account and put it back into another account. We had put it in that estimated account because we knew they were going to return something to us. We just didn't know what it was. We didn't know how much for sure. So when they actually return something, my estimated returns inventory goes down. My regular normal merchandise inventory then goes up. And again, I think the credit part of that is the trickiest part of what we've just done. The only way these entries make sense is if you reflect back on the adjusting entries that you've already made that I had you write down there. Keeping in mind that we close out sales, we close out cost of goods sold. Those other 2 accounts made in the adjusting entry are going to go down over time when people actually return items to us then. Notice that if the buyer's got less accounts payable, the seller has less accounts receivable. And if the buyer has less inventory, the seller must have more inventory. But it is for 2 different amounts because their costs are different. Darth Vader pays Yoda on day 10. Well, first off, we need to see how much he owes. How much did he owe from the original transaction, the first purchase? $39.20. But then what happened in the second transaction? He sent some back. So the amount he owes right now would be $31.36. I'm just paying what I owe on account. This is really a Chapter 2 entry at this point. What do I have less of? What's one thing? I have less cash. Cash is an asset, and assets go down with a credit. So skip a line, let's credit cash. What else do I have less of? Accounts payable. That's my liability, my debt. My liability goes down then with a debit. So we're going to debit accounts payable and credit cash. On the seller's books, what do I have more of? Cash. What do I have less of? Accounts receivable. More cash, an asset goes up with a debit. Less accounts receivable, that's an asset, goes down then with a credit. Notice that if the buyer has less cash, the seller must have more cash. And if the buyer has less accounts payable, the seller must have less accounts receivable. The appropriate party pays the freight bill. FOB shipping point. Legal title to the goods passes at the point of origin when the goods are shipped. At that moment, they become the property of the buyer. When we put them on the plane, the train, the boat, the spaceship to send them to the customer, at that moment, they become the property of the buyer. Who pays the freight cost? Who owns the goods while they're in transit, the buyer or the seller? The buyer. So who pays the freight cost? The buyer pays the freight cost, and they do so with a debit to merchandise inventory. Merchandise inventory. Why? To make the asset go up. It's not that we have more inventory, but the cost of my inventory has gone up. We want the inventory account to reflect the full cost of acquiring that inventory, which would include the cost to get the goods to me. So debit merchandise inventory to make the asset go up. I'm assuming in this case, since we paid it, we're just going to credit cash. Had we received the bill and not yet paid it, we would credit accounts payable instead. The seller does nothing. The seller does nothing. Only one of the 2 parties records the freight cost, never both. Darth Vader sells to Luke 6 lightsabers for $500 cash each. Let's be Luke first. We're going to buy 6 lightsabers, pay $500 cash each. What do I have more of? I have more inventory. Inventory is an asset, and assets go up with a debit. So I'm going to make a $3,000 debit to merchandise inventory. What do I have less of? I have less cash. That's an asset, and it goes down then with a credit. Now I'm the seller. I have just sold 6 lightsabers for $500 each cash. What do I have more of? I have more cash. An asset goes up with a debit. What else do I have more of? More sales. Sales is revenue, and revenue goes up with a credit. So we're going to debit cash, credit sales. Now we need to make a second entry to update my inventory, don't I? Okay. Now I want you to go and figure out the debit and credit. Then we'll come back to the amount though. Right, I've made a sale. What do I have less of? Less merchandise inventory. Inventory is an asset, and assets go down with a credit. So on the second line, skip your line, on the second line we're going to credit merchandise inventory. When I bought the inventory, it was an asset to me. When does inventory become an expense to me? Only when I sell it. Like supplies I use and inventory I sell, exactly. What do we call that expense account though? Whenever we sell our inventory, we give it a special name, and that's called what? Cost of merchandise sold. Good. So I want you to write down a debit to cost of merchandise sold and a credit to merchandise inventory. But then I want to talk about the amount for a minute, because the amount of this entry is for how much the inventory cost me. How much it cost me. Well, let's look at the first entry. First off, how much did it cost me? Your first quick answer, if you just read the first entry, would be to say, how much did each lightsaber cost me? In the very first entry, made $400. Would you agree? Look at the first entry. How much did we pay when we bought them? $400. That is the number we're going to use. And matter of fact, you don't need to write down anything that I'm fixing to show you. I just want to give you something to think about. Did each lightsaber actually cost me $400 though? No, there were 2 factors that kind of complicated that. One is the discount did what? Made the $400 go down. What's the other item that would impact my cost? The shipping cost, and that would make my cost go up. So actually, let's see, I bought $39.20, returned $7.84, so I ended up keeping $31.36. Had to pay the freight. So overall, I actually paid $33.36, and that covered the 8 lightsabers that I kept. Bought 10, sent back 2. So that really comes up to $417 per lightsaber, to be precise. Now, for our purposes, we're going to use the 400. We're going to use the number 400, but I want you to realize that the lightsabers actually cost me something more than that. We're trying to keep things simple. This is 101. We're going to keep things simple. We're going to use that 400. Just realize that in actuality, it gets more complicated than that. Back to the fact that we need to make the entry to record the lightsabers that are now gone. Well, 6 of them, $400 each, would be $2,400, and that's my debit to cost of goods sold and credit to merchandise inventory. How are we doing that sale? Did we make money or did we lose money? How much did we make? How much did I sell it for? $3,000. How much did it cost me? $2,400. I want you to think about these numbers as we write them up there. You can see how we did. We made a profit in this case of $600, didn't we? Notice that if the buyer has less cash, the seller must have more cash. And if the buyer has more inventory, the seller must have less inventory, but they will be for 2 different amounts because their costs are different. Luke sends back 2 lightsabers. All right, let's be Luke, the one returning the lightsabers. Have we paid for these yet? Yes. So will they give me a cash refund? How much will they give me back? $1,000. 2 of them, $500 is $1,000. So we're going to return 2 lightsabers that I bought to resell. They're going to give me back $1,000. What do I have more of? Cash and asset goes up with a debit. What do I have less of? I have less inventory, and asset goes down with the credit. The trickier part is recording this on the seller's books when a customer brings something back to me. It takes not 1 but 2 journal entries. I think it will be easier for you if you would look back on the prior page wherever you jotted down the adjusting entry related to sales returns that gets recorded. What's one thing I have less of? $1,000 less of when this customer brings this back to me. Cash. Let's do the easy part first. I always believe the easy part first. Less cash. Cash is an asset and it goes down with a credit. So would you skip the debit? Let's come in and credit cash for $1,000. What else do I have less of that's still on my books from that adjusting entry? Remember, there are only 2 accounts we don't close out from the adjusting entries. We've got what? customer refunds payable, and estimated returns inventory. So what will I have $1,000 less of now? My customer refund payable needs to go down, because when I actually pay a refund, the amount that I estimate that I still owe in refunds would be reduced. It needs to go down. Liabilities go down then with a debit. And as you just said, we're going to credit cash. The second entry is going to be to update the inventory. Customer brings stuff back to me. The inventory cost me how much when I originally bought it. How much did I pay for each lightsaber? Yeah, we're going to use $400, right, is what I paid for it. We said it's really $417, but we're going to use $400. We're going to keep things simple. What do I have more of when the customer brings these lightsabers back to me? More inventory. There's nothing wrong with it. They just didn't like the color. Inventory is an asset. Assets go up with a debit. I guess they're different colors of lightsabers, aren't there? And the credit is what I think is kind of the odd part of this. My credit goes to the estimated returns inventory. When somebody actually brings it back to me, I have to take that amount out of the estimated returns inventory and put it into the actual merchandise inventory, now that we know what the amount is and which items exactly. Do notice if the buyer's got more cash, the seller must have less cash. And if the buyer has less inventory, the seller must have more inventory, again for two different amounts. Darth Vader buys from Watto 20 lightsabers, $450 each. Terms $310, net $60, FOB destination. The lightsabers originally cost Watto $275 each. Is this going to be a cash or a credit transaction? Credit. How do we know that? Terms. What amount am I going to record this transaction at? $9,000 total to start with. We knock 3% off of that is $270. $9,000 minus the $270 says we're going to record the purchase and the sale at $87.30. On the buyer's books, what do I have more of? More inventory. An asset goes up with the debit. And what else do I have more of? Accounts payable. A liability goes up with the credit. On the seller's books, what do I have more of? Accounts receivable. What else do I have more of? Sales. Good. The second entry is to update the inventory. We're selling 20 items. It cost me $275 each. That's a total of $5,500. When I sell the inventory, it becomes what to me? An expense. And we call that expense what? Cost of merchandise sold. So I have more cost of merchandise sold. And what do I have less of? Merchandise inventory. How do we do on that sale? We did pretty good, I think. How much did we make, roughly? About $3,000, $32.30 to be precise, right? Do you see how you can compare the sales and the cost of goods sold and see if we had a profit then? Notice if the buyer's got more inventory, the seller's got to have less. If the buyer has more accounts payable, the seller has more accounts receivable. Freight bill, FOB destination, legal title to the goods, passes when they arrive at the destination. So the whole time the goods are in transit, who do they belong to, the buyer or the seller? They belong to the seller. The seller pays the freight cost with a debit to what? Delivery expense. Okay? And since we paid it, we'll credit cash. Buyer does nothing. Only one of the two parties records the freight cost. Darth Vader pays on day 10. How much does he owe? $87.30. $87.30. So now he's just like a Chapter 2 entry, isn't he? Paying off an amount that he owes. What do we have less of? What's one thing? Less accounts payable. That's my liabilities. Liabilities go down then with a debit. What else do I have less of? Less cash. An asset goes down with a credit. What does the seller have more of? Cash. An asset goes up with a debit. And what do they have less of? Accounts receivable. Do you see how that's back to Chapter 2? We could have made that entry in Chapter 2. Notice that the buyer has less accounts payable, the seller has less accounts receivable. And if the buyer has less cash, the seller has more cash. Let's make a journal entry for a return. A return. We've done one of those a minute ago. The only thing different now is this was a credit purchase to begin with, right? Then what happened? We paid it off. So will they give me a cash refund this time? Yes, because I have paid for it. Remember that if we took a discount off of the original purchase, we're also going to have to do the same here with the return. What's the amount of the return going to be? $873? $900 minus the 3%? What do we have more of? Cash, an asset goes up with the debit. What do we have less of? Inventory, an asset goes down with the credit. It's the $900 less the 3% discount gives me the $873. How about the seller? What account do we debit for $873 when the customer brings something back to me. Customer refunds payable. That liability goes down then with a debit. That was the hard part. The easy part is, what do I have $873 less of? Less cash, and asset goes down with the credit. Second part of the entry is to update the inventory. The items cost me $275 each when I bought them, or a total of $550. Customer brings them back to me. I'm going to put them back on the shelf to sell to the next customer. So what do I have more of? We have more inventory, and asset goes up with the debit. The credit, again, to me, this is the tricky part of the entry. The credit goes to the estimated returns inventory. That account went on our books in the adjusting entry for the amount we thought customers would return to us. When they actually return it, we have to take it out of that account and put it into my regular merchandise inventory account. Notice if the buyer has less inventory, the seller's got more. And if the buyer has more cash, the seller must have less cash then.